When I looked at the gold silver ratio, was that you'd have, I thought, okay, gold could peak conservatively at $5,000, and if you have a 15-to-1 ratio, that was $333 silver.
Yeah.
So that's one indicator. I can't remember the numbers specifically that I used for the Dow silver ratio. I'm pretty sure in the average home price to silver ratio, it was something like 1,400 ounces of silver at the peak in 1980 to the average home price in the US. At the top, when silver was $4 in 2001, it was about 44,000 ounces of silver that it took to buy the average home price, average home in the US. I believe, and if you only take, this is without home prices increasing, if you go back to the 1,400 to 1, 1,400 silver ounces to the average home price of, let's say, $500,000 US, you're at $300 silver.
The precious metals market has just witnessed a capitulation event, with gold testing $5,000 and silver crashing nearly 30% from a record high of $120 to under $75 per ounce in a single day. While this bloodbath was triggered by Federal Reserve uncertainty and massive profit-taking, many experts view it as a necessary technical correction in an ongoing bull market. With silver supply deficits entering their fifth year and industrial demand from AI and green energy hitting 67% of the total market, the pressure is mounting on a thinning physical supply. Investment expert Peter Krauth, author of The Silver Stock Investor, argues that this mania phase could eventually push silver to $300. By analyzing historical gold to silver and home price to silver ratios, he demonstrates that silver remains undervalued relative to other major assets. Krauth explains how surging industrial needs are squeezing out investors, creating a powder keg for prices when capital rotates back into the sector. He specifically highlights the massive profit potential in silver mining stocks, which are currently lagging behind the metal's gains, but for how much longer? Watch to find out. Now, we present the clips from Peter Krauth interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Silver had become way overpriced because it took, on average and historically, much fewer silver ounces to buy these other assets.
Okay.
So one good example is the gold-silver ratio.
Yes.
So 15 to 1 in 1980. And so I said, all right, if I'm going to use that as some kind of an indicator of where silver could go, for gold, I'm going to have to make an assumption of where the gold price would go.
Yeah.
So here's what's interesting. At the time, and it's in the book, I said, ultimately, I think gold can go to $5,000. When I looked at the gold-silver ratio, was that you'd have, I thought, okay, gold could peak conservatively at $5,000, and if you have a 15-to-1 ratio, that was $333 silver.
Yeah.
So that's one indicator. I can't remember the numbers specifically that I used for the Dow silver ratio. I'm pretty sure in the average home price to silver ratio, it was something like 1,400 ounces of silver at the peak in 1980 to the average home price in the US. At the top, when silver was $4 in 2001, it was about 44,000 ounces of silver that it took to buy the average home price, average home in the US. I believe, and if you only take, this is without home prices increasing, if you go back to the 1,400 to 1, 1,400 silver ounces to the average home price of, let's say, $500,000 US, you're at $300 silver.
Right.
So there were multiple indicators that all said to me, that's the kind of range realistically that I think ultimately we could reach in a mania phase for silver. What got silver to that peak? And what are the indicators? What are the ratios and other things? How did it compare to other assets at that time? So the gold-silver ratio bottomed at 15 to 1, meaning it took only 15 ounces of silver in 1980 to buy 1 ounce of gold. The Dow ratio, the Dow to silver ratio bottomed. The average home price to silver ratio bottomed. So what all of that meant was silver had become way overpriced because it took, on average and historically, much fewer silver ounces to buy these other assets.
Okay.
So one good example is the gold-silver ratio.
Yes.
So 15 to 1 in 1980. And so I said, all right, if I'm going to use that as some kind of an indicator of where silver could go, for gold, I'm going to have to make an assumption of where the gold price would go. Silver is difficult, if not impossible, to substitute in many, many cases. So the industrial consumers need their silver. The investors don't technically need their silver. But what has happened is that just in the last few years, industrial consumption has gone from 50% of the overall demand to 67% of overall demand. So what does that do? It squeezes out the amount of silver that is left over for investors. So what does that do? Well, when investors start to come back into the market, like we've seen over the last sort of 5-6 months, is that it squeezes the price of silver up because there's less silver available for the investment side. Because the industrial consumers, believe me, they're not going to do without their silver.
Yeah.
They absolutely need it to get the product out, and they'll get it. So that's why I say that the investment side of it can ebb and flow, but when it flows, look out, because that can really push silver prices higher. Silver has been money for 5,000 years. I don't think that's gonna, it's not technically officially money today, but certainly lots of people will take it in exchange for other things, and they're taking it in exchange for fiat right now, and it's been a good trade for several. If you had moved in for a few years back, so. No, I don't think it's going to be a meme coin. I think, when we get to a mania phase, that, we might argue that differently, but I think we're a ways off from that. What we've seen in this move in silver has yet to be reflected in the valuations of the silver stocks. Just technically, you look at SIL, the silver ETF, and SILJ, another silver ETF. And if you look at a 2-year chart, silver and those mining ETFs are even. So those miners have offered zero leverage over silver in the last 2 years.
Yeah.
What has happened is that the price has moved so quickly that analysts are still using $30, $35 silver. Over the next, couple of quarters, they're going to start to move up the numbers that they're using. They're going to probably end up being closer to $40, $50. And we're still at, call it 90 or 100. So I think, but the fact is, though, that although the analysts are using, say, $50, the miners who are producing and cash flowing, those cash flows are going to come out selling the silver at $90 and $100. So their profit margins are exploding. And after the next couple of quarters that they report, and the market starts to see, wow, these are like cash machines because their margins are so big. I think that's when we're going to get a rotation into the sector, and we're going to get a re-rate in the sector. So that's why I believe, we're nowhere near where we could be in silver mining stocks. That's probably going to start soon, and it could go for 2-3 years.
Peter Krauth reveals the hidden mechanics behind silver's recent price action, specifically pointing to the rapid draining of global stockpiles that previously suppressed prices. He explains that while industrial giants have relied on secondary inventories at the COMEX and LBMA for years, these above-ground supplies are hitting critically tight levels after a 40 to 50% drawdown. Krauth notes that the gold-silver ratio, which historically overcorrects when it drops, could fall to 40 or lower, suggesting silver is on a non-linear path higher even if gold remains stable, with a 50-to-1 ratio at $5,000 gold already implying $100 silver. He warns that the market is entering a phase where sideways movement is just a pit stop before the next major climb. Let's get back to his interview.
If we're in a silver supply deficit, how come the price of silver isn't running up, is not compensating for that? And so I started looking around what would explain that. And the conclusion I had was that there were silver stockpiles, basically secondary inventories that were sitting on the COMEX, at LBMA, and at Shanghai. So several billion ounces. And especially the industrial consumers, were able to go to these markets, buy a futures contract, wait for maturity, take delivery, and because you had this sizable amount of silver that was already mined, that was sitting above ground, any big consumer could go and buy this silver. But if you're buying the silver where it's already been produced, that puts zero pressure on the miners to bring new production to market.
Yeah.
So I had been saying these, you could see it by looking at the inventories. These inventories peaked in early 2021. Within about a year and a half, they had drained by about 40-50%. And I said in early 2024, we've got about 12 to 18 months left of this. And then these inventories get way too tight. And then it's all bets are off. And essentially, that's how it's played out. The market came to terms with the fact, and there's actually a report by TD Securities that came out probably about 2 weeks after I said that at a conference that said essentially the same thing. We can't support these. These inventories are being drawn down much too quickly, and again, 12 to 18 months before they're drawn down to levels that are much too tight. And then we're going to have to see a price response. And that's what took place. If you look back at the last, say, 20, 25 years, the average in the ratio is pretty high. It's kind of moved higher over the last several decades. And frankly, it's been closer to about 55, 60. But what we do see, if we look historically, is that when the ratio starts to drop meaningfully the way it has lately, it tends to overcorrect, meaning that it doesn't just go back to sort of average of where it's been over the last few decades. It tends to go much lower.
Yeah.
So frankly, at this point, I would expect the ratio, not tomorrow, but that we're not that far off, but it could go to somewhere like 40 or perhaps even lower. And like you said, in 2011, it was at 30. So we don't even have to go to that level to get to a lower level than where we are now. And if gold stays where it is, that suggests potentially even higher silver prices. But in terms of what's sustainable, frankly, I think we could probably be in an area of over an extended period of time, somewhere like 50, 55. And, if gold stays where it is and silver rises, a 50 to 1 ratio at $5,000 gold is $100 silver, right? 50 to 1 on $5,000 gold. So I believe that, after a correction in the silver price, we're going to either move sideways for a while or start climbing again. Either way, on balance, I believe we are moving higher.
As the silver market enters 2026, analysts emphasize that we are transitioning from a steady climb to a potentially explosive mania phase, fueled by a fifth consecutive year of structural supply deficits. Peter Krauth points out that while higher prices usually incentivize production, silver's unique status as a byproduct of other mining operations means supply is incredibly inelastic. Even at record price levels, primary producers cannot simply flip a switch to meet surging demand from AI and green energy sectors. This creates a perfect storm where industrial consumers, who are price insensitive because silver is a tiny fraction of their total costs, continue to bid prices higher. Ultimately, the real prize may lie in high-quality silver mining stocks, which are beginning to act like cash machines as their profit margins explode. Krauth notes that with silver prices recently breaking into the triple digits, miners producing at $30 to $35 per ounce are seeing a massive re-rating in their valuations as analysts adjust to this new $100+ reality. This creates a rare window where the stocks offer massive leverage over the physical metal, with some portfolios already seeing gains exceeding 900%. As the global musical chairs for physical silver intensifies among London, New York, and Shanghai hubs, the question is no longer if a supply crisis will occur, but which investors will be positioned when the final force majeure event strikes the exchanges. Could a black swan delivery failure in Shanghai be the catalyst that sends silver toward the $300 target sooner than anyone expected? Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.